Hey, good morning, everyone. Good morning.
Good
Good
morning.
morning.
Hi.
Good morning, Professor.
Good morning. Good morning. Um, all right. I see 7 people here today, this morning. And let me quickly check how many are in the forum, in today's forum. Looks like I have more people here, at least 12 people here in the forum. Now, as you can as you know, after today, we'll have only 2 more classes left, right? Today is April 30th. And then after that, we're going to have May 7th. And then, May 11th. And that's the last day. So to be honest with you, we won't be able to finish everything uh, in the syllabus. But everything has been covered already by the main lecture. I mean, if you have been following the main lecture, um, we'll be done. Everything will be covered uh, by the May 11th. So um, please remember that collaborate session is not the main lecture. Collaborate session is only the reflection, review and reflection of the main lecture, right? So please, keep up with the main lecture, right? Please don't, just rely on the, uh, obviously, by the collaborate session, we won't be able to cover everything. But, still, the collaborate session is important because what you don't understand from the main lecture, um, you'll have more solid understanding through the review, right? So uh, so if I okay, let's go back to where we were last time, right? Of course, we were talking about continuous compounding, why continuous compounding is needed, and so we talked about the scenario analysis because the scenario analysis is basically what most of the fund managers or all asset management companies use, right? And because they would have certain scenarios like what's going to be the state of the economy next year, or this year, I mean, the economy can have 4 different states, severe recession, right? It can have it can be in severe recession or mild recession, normal growth, or boom, right? Economic boom. Now, then what would be the probabilities of these different states or these different scenarios? 5%. Probability of severe recession is 5%, or mild recession 25%, normal growth 40%, boom 30%. But who makes these predictions? I mean, where do they get these probabilities from? I told you they usually use what they call Monte Carlo studies or Monte Carlo simulations. Okay. No matter, nobody will just say, oh, from my own experience, I mean, even if you are like, Peter Lynch, and you remember who Peter Lynch, um, if you remember who Peter Lynch is from our previous chapters, legendary, nobody can just say, oh, this is, from my experience, this is the problem. No, the probability is has to come from the uh, probability simulation, and it's called, generally Monte Carlo studies, and based on that probability, and then weighted, probability weighted, right? Probability weighted uh, returns. These are the returns under severe recession, right? Under mild recession, under these are the returns under each scenario, right? And the uh, probability weighted returns would be, probability times, column B times column C, probability times the returns, and then if you sum, right, sum all of that, right, and the result is this is weighted average, right? This is weighted average. Weighted average is the expected return, because that's what is expected. I mean, there are four different possibilities of different states of the economy. So it's quite rational to use the weighted average as the expected return, right? And the expected return will be 10%. And then we find, we want to find the average deviation. To find average deviation, because, what is the deviation of this severe recession result from the expected return? Um, so to find the deviances, and then uh, uh, we need to find the variance first. And the variance is what? Variance is um, sum of all the squared terms, right? Squared difference terms, sum of all the squared difference terms over n minus 1, right? In other words, sum of, this is SSQ, sum of squared difference terms, right? This is the deviation is the difference term, right? Because that's, a difference between the holding period, the return in each state, and the mean, right? So sum of squared difference terms, and that's, but in this case, since so normally they write it like sum of ah, sum of xi minus x bar, squared, right? Because it's sum. Um, X bar is the mean, average. When you have a bar on, that means average. And xi is each individual data. So xi is negative 37%, negative 11%, 14%, 30%. Those things are individual returns, right? Xi, I meaning individual, right? Individual data point. And X bar is the mean. So N is the total number of, data sets, data points or observations. That's normally how you express, um, uh, variance. But but in our example, we are we have everything is weighted. In other words, so it becomes the same thing as weight of I, sum of weight of I times x bar squared. That's the same thing as dividing by n. Okay. In other words, that's what this is all about, right? Now you recognize this, right? Just I only used xi and x bar because x is our return. Instead of r, I just used x, and then but when we have probabilities, this is probability, right? This means probability of S happening, right? S means stock X, right? That's obvious, right? If you weight it by the probability, and so this is, again, xi minus x bar, and the whole thing squared, right? So some might wonder, so how is it the same thing? I mean, this is really, you should have already taken, statistics, math 209. But also in Finance 100, I talk about this in Finance 100, but usually we don't have much time to touch on the probability theory. But the idea is like this. Think about it. When we say, we all know, if we are playing a very hackneyed example in probability or statistics is dice, right? A dice has numbers on every side, right? And the probability of any number coming up, right? Probability of any number, right, coming up is all the same, right? And then think about it. What is the average average of all any number? Suppose we are playing a dice game where you win the dollar amount that comes up on the dice. I mean, you have one chance of rolling a dice. So when you roll a dice, whatever number comes up, you win that dollar amount. So if one comes up, you win $1. 6 comes up, you win $6. And we know the probabilities are all the same, right? And because nobody will question. Then what is the expected payoff from this game? What's the expected payoff? And when I ask this question, a lot of students tell me $6 or $1. $6 or $1. Why? I ask them why. And they all say, I mean, someone who says $6 are very optimistic because I want to win $6 because that's the maximum amount. But they are very optimistic. Those who answer $6, but then they don't realize that that is not the likeliest outcome. Isn't that right? It's not the likeliest outcome. Likeliest outcome, right? It's only their wishful thinking. Those who say $6, they're just expressing their wishful thinking, not but that's not the likeliest case. And those who say $1 are very pessimistic, and they are rather on very risk-averse people. And they, because what they are saying is, at least I will win $1, at least, right? You cannot win less than $1. Yeah, very realistic and but also pessimistic. But that's not the likeliest case. So what would be the likeliest case? It's the weighted average, right? It's the weighted average. Weighted average of all these possible outcomes. So the weighted average is basically what? Oh well, literally. Let me rewrite it here. So the expected payoff is the weighted average of all these. So that means all the possible outcomes are weighted by their probability. So then, it's 1/6 plus $1. Plus 1/6 times $2, right? And you know the drill. If we keep going like this, for every possible outcome, right, everything is divided by 6, right? Everything is divided by 6. So in other words, you can factor out 1/6, and then here, the rest of them are just the sum of all the numbers, right? Where I runs from 1 through 6. Does that make sense? Which is the same thing as sum of 1 through 6, sum of 1 through 6 divided by 6, which is what? Oh, isn't that the simple average that we know of? Yes, that's the simple average. Now, so in other words, in case of the dice, it's a special case where weighted average is the same thing as the simple average in case of the dice, right? Why? Because they happen to have the same probability. If they have the same probability, then it's just the weighted average becomes simple average, right? Simple average. But again, then the difference between the weighted average and the simple average will be quite obvious when the weights are different, right? Weights are the probabilities. Weights are different. So we can tell, this turns into, dividing by n, it turns into this, right? Because weights are not the same. Weights are not the same, right? Everyone is following. Everyone follows so far. Everyone? Where is everybody? Everyone is following so far?
Yes, Professor.
Yes, Professor.
Okay, 2 people. Only 2 people. What about the rest of the
Professor.
class?
Yeah, Professor.
All right,
sir.
thank you. Thank you. Okay, at least, yeah, I get more traction. I mean, I should say attention, but Oh, am I still sharing my screen? Do you see my screen? Did I
No.
Cut
accidentally?
off.
Oh, I
Yeah, it
accidentally.
cut off, Professor.
Just now, right? I accidentally. Okay, now I get more traction, and so it's really it's rewarding. It's it's rewarding to teach 300 because at least people what's happening. Yeah, it's
Yo puedo tapar la
I'm
cámara.
sharing now. Mhm. Because I get some attention. I get traction.
Yeah.
When I talk about this in Finance 300, I get some traction. But when I talk about this in Finance 100, almost I lose almost everybody. Almost everybody cannot follow. But at least I get some traction when I talk about it in 300. Um, so now you understand why variance takes this form, right? So that's where we were. We were. So what is variance? Variance is basically average deviation from the mean. Average deviation from the mean, right? But then uh, uh, it's actually a blown up picture of the average deviation, right? Because you squared it, right? You squared the difference terms, right? Uh, you squared the difference terms, right? Uh, so it's a blown up picture, not the life-size picture. And we know how to then turn the blown up picture into life-size picture, back into life-size picture. We know how because variance is also expressed by the sigma square. Sigma square is the sigma stands for standard deviation, right? So life size picture of variance is the standard deviation. Life size of the variance is life size picture of the variance is the standard deviation. So we know if we take the square root of variance, right? Then take the square root of who is this yawning? If we take the square root of variance, right? That's square root, right? That's standard deviation. But again, we know because this is variance, right? Taking the square root will take it to sigma. And the sigma is standard deviation. This means standard deviation. Okay. Now, what I'm about to discuss is very heady subject, but so you have to stay focused. So I've done this on Excel. I was just reviewing what we did last time. So this is what we did last time, and then our next question is we talked about the properties of normal distribution, and then suddenly the book talks about the um, value at risk. But value it's better. Value at risk. Um, it's not variance. Some people may say, "Oh, isn't that variance?" No, there's a reason why I use a lowercase there, because that means value at risk. It's easier to come back to this later. So last time I left you with a question. Okay, so we did this last time, right? So then the question is our result. So our scenario gave us our scenario gave us 10% expected return and the standard deviation of 18.63, which means, the mean is 10%. So let's go to the mean is 10%, and the standard deviation is 18, almost 20, right? Mean is 10%. Standard deviation is 18%, something like, almost 20%. But if that is, and the question is, if this is a normal distribution, then it will show this pattern, but we don't know. Our scenario is exactly this beautifully symmetrical picture like this. If the distribution of our scenario, right, the 5% probability of severe recession, 20% probability of mild recession, blah blah. Does our mean and standard deviation, will be part of this perfectly symmetrical bell-shaped curve? It may not be. It may, as I said, this distribution may have actually, mean may be here, but it may be distributed like this. I mean, that's not okay. If the mean is there, it may not. It may be more like this, or who knows? It may be the actual distribution of our scenario may be more skewed like this. This is skewed to the right, skewed to the left. So we want to confirm or verify whether our scenario is normally distributed or not. Why? Why is that important? Because only under normal distribution we can assume that we can have that within one standard deviation there's 68% probability that the will have returns between 18% below within 18% around the mean, or there is 96% probability that all 96% probability that the returns will fall within 2 standard deviations. I mean, those properties of normal distribution, we can use it only if our results are normally distributed, right? So that's why next we have to check the normality. First of all, normality over time. Normality assumes that if the data set is randomly distributed, if you have a fairly large data set, a sufficiently large data set, and what is the sufficiently large data set? If we have, right, if if the data set has more than 30 data points, then generally, and if they are randomly selected, right, randomly selected data points, then it would be normally distributed, and it's ND, this wavy, squiggly wavy wave sign means distributed, right? Normally distributed. That means and normally we use it like this, mean, the mean and standard deviation of our data set, right? using mean and standard deviation of our data set, we use this squiggly sign, and then this data set is normally distributed, right? That means. So we have to verify this. And so think of it this way. If we have, if you look at every day, look at the market, look at the market data. Let's say Apple, right? We had a very bad day yesterday. At the early yesterday, it was all green, and then I thought yesterday I was away and I didn't get a chance to monitor the market. At the end of the day, I checked the market, everything was all in red suddenly, and this was so disappointing because yesterday, you see, the Asian market and European market is Australian AX, that's Australia, Nikkei, that's Korean market, China, Shanghai, Hang Seng. So Australian, come on, why isn't it going back? So, and then think about it. Australian market is on top because the day breaks from Australia, right? You understand what I'm saying? The day breaks from Australia. Why? Because that's where the sun rises. The sun rises first. Of course, the international date line. I mean, in other words, nobody has any earlier date than Australia. I mean, because in the Pacific there is an international date line. So if we fly from Los Angeles towards across South Pacific, right, across Pacific, past Hawaii at some point, right before Australia, then there is international date line, and then when you cross it, it's the next day, right? When you cross it, so in that chronological order, and then European market, right? DAX, that's German. This is French, FCHI, that's called Le CAC, that's French, index. FTSE, and then BVSP is, Brazilian, because Brazil starts the day 1 hour earlier than U.S. East Coast, right? And then Dow Jones, Standard & Poor's, and NASDAQ. I mean, Asian market and European market were so good yesterday, and suddenly, U.S. market, no reason for that. No reason, really. Actually, inflation expected, the interest rate hike, but it's not unexpected. Everything was, interest rate hike is already expected. I mean, it should have been already priced in. I mean, it doesn't, just because of that, it doesn't mean the economy is bad. Actually, the economy is actually, labor market is very tight. People have hard time. I mean, companies have hard time filling their jobs, filling their openings. Everyone able-bodied and willing to work all have jobs, and everyone, it's called great resignation, because a lot of people, a lot of baby boomers retired during the pandemic. Now all of those, almost 4 million. Of course, some of them were just reshuffling, because as the those higher paying upper level positions opened up, younger people moved up. They took over that they move to another job with higher pay, and so it's more like great reshuffling rather than great resignation. But anyway, of course, because of the supply shortage, the GDP, the output is not where it should be. But anyway, within the given constraints, economy isn't bad. I mean, the inflation is only sign of a very strong demand, and of course, due to shortage of supply, the ensuing input cost, rise in input cost, But again, what am I? So what I'm trying to say is, let's say you look up Apple. And look at the daily price. It's really random. Isn't that right? I mean, of course, there's a trend in daily price, but during the day, let's say one day, all these, and then if we, 5 year, I mean, there's a trend over time. But basically, day to day, price movements are really random. Let's see, if it is, day to day, and even within the day, the price movements are really random. It's really, have you ever heard of random walk? What random walk is? Anybody heard of random walk? What is random walk? Anyone? Never heard of it? Are you guys there?
Yes, we hear.
Yes, for sure.
Yeah. All right, thank you. So Irina, Dmitry, who was that? Irina, Dmitry, Damien, Bevan. I think 4 people replied, right? Isn't that right? Damien, you replied a while ago, right? Damien, Devin, Dmitry.
Yes, Professor.
Yeah,
Okay.
Professor, we're here.
Okay, Sebastian. I believe Shabir was, earlier. So I'll give these people 0.5. Okay. So that was Damien,
Because I did reply earlier.
Irina, Devin. Devin, are you there? Devin? Okay. Dmitry. Dimitro. And Irina. Shabir. Shabir, are you there? Shabir? And that was Sebastian, right?
Yes, Professor.
Okay, Shabir. Sebastian. Yep. Okay. So these people who actively participated in class, you guys deserve, 0.5 at least for
Professor,
that.
I did reply earlier.
Yeah, alpha. Yeah, alpha. Okay. Alpha. So yeah, it's hard to go by alphabetical order. I mean, it's not. I mean, it's hard to spot the names, and as the microphone comes on, right? As the microphone icon comes up, it's hard to spot it in alphabetical order. I mean, if I can, remember it in alphabetical order, it would be wonderful. Yeah. So all of you, should be okay. So where was I? Again,
You were
about to discuss. You're about to explain random walk.
Yeah, exactly.
Yeah. So what is a random walk? I mean, random walk is another name for Brownian motion. And what's Brownian motion? This is in physics, I mean, you must have heard Brownian motion. Yeah, and in physics, Brownian motion is the movement of the gas particles, right? In other words, Brownian motion. In other words, there is no particular pattern. It's really random, right? The particles, gas particles move in really random pattern, right? That's what random walk is. Because in the stock market, it doesn't make a turnaround like this, but the gas particles would really move this way. So in the stock market, stock prices in the short run are random walk, really. Random walk in the short run, right? In the long run, it will have some deterministic pattern, but in the short run, that's why I was trying to show you where's the Yahoo Finance. Okay, so this is daily price movement over the last 5 years, but let's just take a look at this alone isn't even 5 years, but if I move it further that way, but within, let's say within just 1 day, let's take a look at this is 1 day, right? Price movement of Apple, right? By the minute. And then, of course, yesterday, overall, there was a downward trend, but minute by minute, look at minute by minute. It's really a random walk. 1 year, looking at, 1 year and the daily price movement. There, overall, there's a trend, but from day to day, it's really random walk. Randomness, this is what ensures normality. This is what ensures normal distribution. Okay, but then the question is this scenario, does it follow? Does it have randomness? So we want to verify the randomness of our data. And first, normality, let's think about the normality over time. I mean, we know, daily prices, they are really random. It's a randomly distributed, outcome, day-to-day price changes. But monthly, if monthly returns are randomly distributed with the mean of 1%, does that mean annual returns are also randomly? No, it's not. Why? We know that if mean is 1%, that means annually it will be 1 plus r raised to 12. Isn't that right? That's gross return. So you subtract 1. That's net return. This is not normally distributed. Annual return is a non-linear function of monthly return. Non-linear, because it's a power function. It's not like monthly return times 12. No, it's not like that. We know it's a 1 plus r raised to 12 minus 1. And this is not normally distributed, right? It's called chi-square distributed. Chi-square distribution is more like, you don't need to know, but all you need to know is not normally distributed. If it is not normally distributed, then we cannot use normal distribution. Chi-square distribution looks more like this. That's anything which is a power function of any data set, which is that is the result of original data set distributed normally, will display chi-square distribution properties. So then can we say monthly distributions are normally distributed as well? If you think about it, monthly return is, unless we use monthly data from the scratch, monthly return, if you think about it, it's a result of daily return raised to 30 over raised to 30 minus 1. So anything that is power function of normally distributed data is chi-square distributed. So, however, but when returns over very short time periods are normally distributed, holding period returns up to 1 month can be treated as normal. Why? And this is the proof of that. Even long-term return is normally distributed by using, if you use continuously compounded rates, continuous compound. So here's the mathematical proof of that. Suppose on annual basis, continuously compounded rate has a mean of 12%. So what does that mean? We have like 30-year data of annual returns, and the annual returns over the last 30 years has ranged over the last 30 years, mean of 12%, and then distribution was we don't know what most likely it would have been like this. We have mean of 12% and certain standard deviation here and here, 2 standard deviation here and here. So these are for the last 30 years. If we have 30 data points, meaning 30 annual returns, and the mean of those, and they would be a continuous numbers. In other words, we just artificially and arbitrarily assumed mean of those numbers are 12%. But think about it, the returns are not an integer. It could be 10.xxx or 11 point something 15 point something. Now think about it, these numbers can be floating numbers. I mean, in other words, they are not exactly integers, but the mean of that is 12%. And then so if we find the effective annual rate, and from previous from last week, you remember between continuously compounded rate is natural log of 1 plus EAR, effective annual rate. So to find EAR, we'll simply have to take the reverse function of natural log, which is Euler's number. So we raise the we take the exponential function of natural log of APR, or which is in this case this. We come to this, right? So So exponential function raised to Euler's number raised to 0.12, 12%, right? Minus 1. You subtract minus 1 to get the net return. Then effective annual interest rate is 12.75%, 12.75. Now the difference between the two is 0.75%, which is statistically meaningful. I mean, it's not insignificant difference, right? It's not, if it is like, 1/100th of 1%, it would be insignificant. It won't be statistically meaningful. But if it is like 75 of 75 over 100, I mean 75th of 100th, right, of a percent, it's statistically meaningful. I mean, it's almost 1% difference, close to 1% difference, right? But if it is annually 12%, on monthly, it is 1%. If it is annually 12%, monthly it would be 1%. So for lack of better term, effective monthly rate. I mean, if this is effective annual rate, effective or equivalent annual rate, effective monthly rate or equivalent monthly rate. So you take the exponential function of 1%, and which would be 0.0105. So the difference between the two, between the continuous rate and continuously compounded rate and effective rate, is only like 0.00005, which is like 10,000, 5 over 10,000, which is a trivial or statistically insignificant difference, trivial difference. So monthly, but if we use continuously compounded rate, because of this trivial, the difference is very trivial, so we can take the monthly returns, continuously compounded monthly returns, as normally distributed. Okay. For shorter periods, like weekly, daily, the difference would be even more insignificant. So then our next question. So continuously compounded rate is a function of time, right? Function of time. Now think about it, which means the longer time period, right? And it goes without saying, you put $10,000 in the bank, or in the stock on the normal economy. The return will be a function of time. The longer you put it into a bank, just like the longer you put it in the bank. So it's in direct proportion to time. That means it's a function of time. And the variance is also a function of time. In other words, the longer, if you put it into a stock, and for a longer period, over time, the compoundings with over time, you have wider variance. You have wider variance, right? Of the Apple is a very good example. I probably have shown you how Apple has behaved. Apple has 40-year, 40-year history. Apple went public in um, Apple went public in 1981, and since then, if you look at the monthly, look at how Apple has, it looks like, the growth until 2007 was, until early 2000 was relatively, uh, insignificant. But actually, if you look at, it's because, if we take a like long-term view, the growth after 2007 is so significant. Apple grew like 130,000%, 130,000% since then, since the beginning. If you look at only if you break up the time prior to 2000 and after 2000, the prior to 2000, if you look at only that time frame, there would be a lot of movements, the variation, but the variation until 2000 is relatively dwarfed by the variance after 2000. And Apple is a lucky case. Some companies may have shown, unlike Apple, some companies could have shown this type of pattern, or even negative. But the point is, some companies may have shown this pattern. I'll tell you which company, Triple D, right? Which is a 3D, I liked the idea of 3D, but I put some money in this company, and then it happened like this. One day it was like this. One day, and when it was like this, I bought it when it was like this, and then. Where was I? So the probability distribution is telling you the probabilities. Now, probabilities can go both ways. When we see normal distribution curve, you only think of it as horizontal thing. But think about it. You can if this is think about it. This is positive returns. This side is positive return. This side is negative return. But over time, if we put it over time, what it is telling you is let's say Apple's return has shown over time, Apple's return has shown this pattern. Good for Apple, but at every point, right? It is the result of, if you expand it like that, think about what right? You understand? At every point, there was a probability of, right, higher returns, probabilities of lower returns. This is, in other words, you should be able to see normal distribution curve this way, right? We happen to had that return in that year, in that month, but the probabilities existed. You understand? The probability of, getting higher return and all these things, existed, right? You get the idea? So just Apple, good. For Apple, what happened was all, what happened to Apple was, actually, probably I should have drawn it like this. What happened to Apple was, all, upside. It's called, upside risk. I mean, think about it. Risk is the reason the standard deviation is the measure of risk is because when we say risk, you think risk is something like, losing money. In other words, getting a return that's below the mean, right? But actually, that's called downside risk, downside, because it's really, that's called downside risk. Oh, what did I do? I just wanted to erase only this. But this is also risk too. It's upside risk. In other words, any probability of deviating from the predicted path, expected mean, right? Expected return, it's a risk. I mean, deviating, the volatility is the risk, right? And the so the standard deviation, that's why, is a measure of risk. Okay, that's why the standard deviation is the measure of the risk. So in case of Apple, mean has moved up and more of the upside, there were more upside risk, but you will see that, also there were, a lot of, downside risk as well. So so we come to basically the conclusion, up to monthly return, we can treat the data as normally distributed. If you use, a continuously compounded return, even annual returns, continuously compounded returns can be treated as, normally distributed. And here's one interesting thing before the time is already like what, 10:40. So I'll put you on a break shortly, but let's think about this. If annual standard deviation is 20%, if annual standard deviation is 20% of, continuously compounded, then annual variance must be 4%. Isn't that right? Some people, I mean, if this is Finance 100, a lot of students don't understand it. Why is it getting, but think about it. Variance is the square term of standard deviation. So 0.2 times 0.2 is going to be 0.04, right? Now, if annual variance is 4%, quarterly variance would have to be 1%, right? Then quarterly standard deviation has to be 10% because it's the square root of, right, 0.1. But then you might think, oh, so then the monthly standard deviation should be 0.33. I mean, 0.033. I mean, because it must be monthly, which is, 1/3. You divide quarterly. Oh, so monthly, if you divide quarterly standard deviation by 3, that must be monthly standard deviation. No, it's 5.77. Why? Anybody? It's because simply, look, we have to get it from the variance. If the quarterly variance is 0.01, right? 0.01. Monthly variance is like this. But then if you take the square root, raised to, if I raise it to 1/2, and what do you get? That's why. In other words, standard deviation doesn't exist by itself per se. I mean, standard deviation is the result of the variance, right? In other words, we always got the standard deviation by first calculating a variance, right? You cannot have standard deviation before variance. Okay, there's variance, and then from variance we get the standard deviation. So that's why here variance, the return grows in proportion to time. Return grows in proportion to time, or return is a function of time, whereas standard deviation is a function of square root of time. Okay, mean, in other words, the return and variances are function of time, but standard deviation is a function of square root of time. Okay, so that's an interesting thing to remember. And then, so after the break, we'll verify if our scenario is normally distributed, right? That's all that, to get to that, we had to review all of this. But, I cannot just assume that you all understand this, because it requires a lot of, comfort level with statistics, a lot of, higher comfort level, and a lot of, foundation in statistics. All right, so we'll take a 10-minute break. It's 10:41, so we'll come back at 10:52. Okay, let's take a 10-minute break. All right, we're back. We're back. So I just noticed that during the break, Anna dropped something in the chat box, right? Anna said, random walk in finance is the theory that stock prices are independent of each other. So the past information cannot be used to predict future prices. Again, independent of each other means, it's not about stock X and Y, not two different stocks, but if you look at stock X, the historical data or time series data, independent, the longitudinal data, in other words, yesterday's price and today's price are not correlated at all, right? They're independent of each other. So yesterday's price is not a measure of prediction for future price, tomorrow's price. That's true. But one thing people generally don't talk about further is that this is a short-term phenomenon. I mean, in the long run, as I said, there is some trend, and that's what we are trying to everybody, and that's what the science is trying to identify, some deterministic trend in everything. Because if everything is really just random walk, then there's no way of utilizing or making use of all the body of knowledge and findings that we have accumulated all this time. In other words, what the academia has. I mean, if we cannot make use of the body of knowledge that the academia has accumulated, right? Then there's no rocket science. There's no nothing, right? And I said earlier, at the beginning, random walk is, purely and predominantly short-term and day-to-day stuff. But so thank you, Anna. And Anna is really a great help and a great resource. So please, everyone, please use or take advantage. I don't know, take advantage. Please make good use of a great resource like Anna. Okay, please, utilize the best resource we have. You're welcome. You're welcome, Anna. So where was I? Where was I? Yeah, next. So how do we verify if our scenario example, the distribution of the results in our scenario example is normally distributed or not? And if it is not, how far or how close is it to the normal distribution, right? Or how different is it? So to do that, and this, I want you to do this with me. So this is the file we used last time, and right below what we did last time, you will have figure 5.2, comparing scenario analysis to normal distribution with the same mean and standard deviation. Yeah, I mean, what would the normal distribution look like if the normal distribution has the same mean and standard deviation as our example, our scenario? So in other words, if it has 10%, the normal distribution of the data that has returns data that has 10% mean and 18.63% standard deviation, what would that look like? So let's do this first. Let's find the I think this is ink. Okay, so I'll have to get rid of the another. So please, everyone is on this? Everyone is on this?
Yes, Professor.
All right, thank you. Just one person.
Yep.
Okay. All right, good. First, the probability is given, and the cumulative probability, we will see why cumulative probability, because we will compare it with the cumulative probability of the likewise normal distribution. Likewise normal distribution means normal distribution with the like mean and standard deviation, right? With the same mean and so cumulative probability, it's easy. I mean, it's just itself. This severe recession, and then what did I do? It's just itself, right? And then cumulative, together with the mild recession, cumulative is just this plus. Let me do it from this plus this, right? Of course, that's 3. And then you drag it down, it should be 1, right? Cumulative. And these are, effective interest rates, annual rates under each, Now, continuously compounded rate, which is, the reason we use that is because it's normally distributed, right? Continuously compounded rates are normally distributed. And then what is the, how do you turn this into a continuously compounded rate? We did that. We talked about that, right? Natural log of 1 plus, right? Natural log of 1 plus EAR, right? Natural log of 1 plus EAR. Okay. And that's, if it is normally distributed, right? The bottom 5% would look like this, right? I mean, bottom 5% under severe recession, under that probability, bottom 5% probability, continuously compounded return would be much, lower, negative 46%. And I drag it down like this. If I drag it down like this, okay, and then expected return, we know it's the probability times this, right? Probability times this, right? So this times this plus this times this plus this times this. Now we can do it in a single shot. We can use a command called sum product. What is sum product? Literally, it means we are summing up the products. Isn't that right? Probability times this, right? I cannot use that, okay? What that means is, think about it, this times this, that's product, plus this times this, that's summing, right? You are summing. So sum product, this column is multiplied to this column. So if you drag it down, right, that's if you drag it down, right, that whole column is, and then you drag it down, that whole column is there. And then I want to lock this because probabilities, it will be used continuously. So I mean, it will be repeated. So I'm gonna lock this so that I can copy it later. You know how to lock, function key F4, right? So hit OK. That gives you 10%. No, why is it doing this? No, not that. And the same idea here. It's probability times this, probability times this. So I'll copy the same command. And that's why I locked in the probabilities. I paste it here. Okay, so then the mean of the this distribution, the way expected return would be this. And then we want to find the variance. So under in our scenario, the difference term is this minus this, and also I'm going to lock the expected return. Squared. Right? Then you drag it down. Okay. And then, so this is basically, a sum of squared difference terms, a sum of squared difference. So I'm gonna sum of squared difference terms. This is also sum of squared. And this is actually, it should be, if I do that for the continuously counted, right? I'm gonna from this, start with the equal sign. Minus this, and I'll lock it also so that I can drag it down. Okay, let's see if you see so far the same numbers, right? Same numbers. And then what is this? But let me find the variance and the standard deviation. The variance will have to be you'll have to multiply it by the probability, right? You'll have to multiply it by the probability. So probability of some product first, you know, some n comma n. And this should be $. You got to lock the probabilities. Oops, what happened? Some product B7. Oh, I didn't lock this. B7, B20, G17 through G20. Why is it 0%? Something's not right here. Something's not right.
Cause you didn't raise it to 2, right? Square.
Right. Squared. I forgot to square it. I'm sorry. You're right. But the squared, it's yeah. You're right. I'm sorry. Yeah, there it was. So this is the variance, right? And then for this is normally distributed case, right? But our variance is the variance of our scenario example is different. And it was found here already. The reason I didn't do it again is this, but what the heck? Let's do it again because we are using this time some product, right? Did I use some product command previously? No, I just did, okay, because at the previously it was already probability weighted here, right? Probability weighted. So let's use some product, right? Some, right? And then this, yeah, the same. And square root of that. Square root of the variance is the standard deviation. I'll get also this, right? Our standard deviation is 18.8. I just want to make sure that yeah, standard deviation 18.81, 18.81. Right? So then what are these numbers? What are these numbers? These numbers are basically, cumulative probability of the likewise normal distribution. I mean, likewise normal distribution is once again the normal distribution with the same mean and the standard deviation. So obviously we can tell this is slightly off. Our scenario analysis is not quite, quite normal distribution. Quite, it doesn't. Why? Because it is slightly off. I mean, if it is normal distribution with these probabilities, mean would be like this, standard deviation pretty much the same. But the mean is obviously in case of normal distribution, the mean would be not 10%. It would be like this. And the cumulative probabilities are, we found cumulative probabilities of our scenario. It was like this, but cumulative probabilities with the same mean of this and standard deviation of this would be like this. It's not even 5%. It would be, I mean, ending up with negative 46% return under the normal distribution with mean of 10% and standard deviation of 18%. The cumulative probability of getting something like this is like even 0.2%. And then cumulative probability of severe recession and mild recession is not even 30%. It's something like 15%, right? And the cumulative probability of severe recession, mild recession, normal growth in our example, in our scenario example, 70%, but it's actually like, normal on the normal distribution, you would have the cumulative probability of 60, almost 61%, and cumulative probability of all of the states, all of the different states, boom, of course, in our scenario it is 1, but actually on the normal distribution, with those probabilities, cumulative probability will be like, how did I find cumulative probabilities? I use this command, normal distribution of E17 is the return, right? The continuously compounded return with a bottom 5% probability, with that, under this mean and this standard deviation, the cumulative probability would be this, right? And this, and so that, let me show you this. If you go to this bottom tab that says z-score, right? You'll find something like this. And what does that, what is that all about? This was Apple's mean and standard monthly mean and standard deviation. But let me change this to the mean we had. Our mean was 10%, right? And our standard deviation was 18.8. So let me link it to and then make it equal to this, and let's drag it down. What is this telling you? This is percentile. Percentile means, percentile is cumulative, right? Bottom 5%, 10%, bottom 10%. So cumulatively, from bottom 0 to 10%, cumulatively bottom 0 to 15%, right? Cumulatively, 15 percentile means from bottom 0% to 50%, all cumulative, right? What would be the z-score equivalent? What I did was, So this gives you it's a lot. Normal distribution inverse, which means what would be the z-score? What would be the z-score when given for that probability when given a mean and the standard deviation? So this is something you already saw, right? Which was what? No, that is the square difference term. And z-score, normally the z-score of the bottom 5% is negative 1.645. But for this mean and standard deviation, what should I say? Okay, I should explain first what z-score is, so it will take a lot of time. But if you click on that command, you will see what it means. It returns the inverse of the normal cumulative distribution for the specified mean and standard deviation. Normal cumulative distribution for that specified mean and standard deviation. So what is a z-score? Z-score is, and some of you may already know z-score if you have taken statistics, but let me, I think I have that in the slide. So if we go back to the slide, and let me erase all this. Now, so in our particular example, right? In our example, the mean was 10% and the standard deviation was 18%. But if we standardize this, so standardized, so you have to understand what is standardized normal distribution. Standardized normal distribution. Standardized normal distribution. So we give a standardized score. Just to standardize it, mean is 0, right? Mean is 0, and one standard deviation is 1. Okay, so ignore. I mean, in our example, mean was 10%, right? And the one standard deviation was 18%. But we just assume mean is if we there are many data sets. Many data sets they may have normal distribution or they may not. But if they have normal distribution, there's a mean and some standard deviation. So we unify all of that. We standardize it by setting mean to 0, and one standard deviation has the score of 1. It's just 1 all the time. Two standard deviations, 1. I mean, two standard deviations are 2. The score of 2 standard deviation is 2. And then that's standard normal distribution. And in standard normal distribution, within one, just like in any normal distribution, within one standard deviations, any data to occur within one standard deviation, the probability is 68%. Any data to occur between 2 standard deviations, the probability is normally they say 96%. So we will have any data to occur within between 2 and 3 standard deviation, 2% probabilities, right? We all know that. Don't need to talk about it any further. Now, so what is the, and we know if something has 1% probability of happening, this would be 1% range, right? If it has 1% probability of happening, what would be the, so this 2 is called z-score, right? 1 is z-score. Z-score 1 is 1 standard deviation. Z-score 2 is 2 standard deviation, right? So think about it. If something has less than 1% probability of happening, but happening in the right tail, what would be the z-score of that? We can tell z-score would be greater than 2, right? For something to happen here in this range, in this tail, z-score has to be greater than 2, right? Also, z-scores would be negative if you go to the left tail, right? This is the z-score of 1 standard deviation below mean is -1. Z-score of 2 standard deviations below mean is 2. So we can do this, z-scores. We can assign z-scores to every probability, right? If the probability is, this is basically bottom 2%, but if it is bottom 5%, if it is bottom 5%, if it is bottom 5% probability, it's the area below a certain z-score. And what would be that z-score for bottom 5% and below? That z-score is negative because it's left tail, negative, it's negative 1.6 something. If this is -2, right? 2 standard deviation, right? Below mean, 1.56, something like that. Let me, yeah, 1.645. Okay. Also, that means, upper tail is the same thing. If it is upper tail, right? And if you are looking at some data that happens within the upper 5% right tail range, right? The z-score of that point would be 1.6 positive 1.645. But when we the z-score right tail, but when we talk about the cumulative probability, we count cumulative probability from the bottom, in other words, in percentile, right? So this is like the cumulative probability would be 95 percentile, because from here all the way here, right? And think about it. So the cumulative probability, although by z-score, it's just a mirror image, right? Z-score, the bottom 5%, z-score is negative 1.645. Upper tail, right, or the right tail, z-score is also it's mirror image 1.645, but cumulative probability is quite different, right? Bottom 5%, that's bottom 5% cumulative probability, but so that's 5 percentile, and the cumulative probability of the z-score of 1.645 is 95 percentile, right? Anyway, what I've shown you here is if you want to find the z-score of the bottom 5%, you use normal standard deviation inverse command, right? Okay, normal standard deviation inverse, but that's that gives you the z-score of the standard deviation. Z-score equivalent for that z-score. So this is normal distribution inverse. So given the same mean and the standard deviation, given this mean and standard deviation, what would be the bottom 5%? And the bottom 5% will be, for this distribution, negative 20.64% return is the bottom 5% result, right? And check out also then okay. I'm not going to go into anything much. This is cumulative. This is called cumulative distribution function, right? Under that z-score. Of course, under that z-score, under this z-score, cumulative distribution, which is, it will give you the percentile, right? So I'm not going to go further into this because we don't have time for that. The whole point is we have where was I? So this is giving you cumulative likewise normal distribution. So which is the function that I just used, right? This is what, if I turn it into percentage, that's exactly, if I turn it into percentage, you will get slightly different. I mean, why is it like this? Normal inverse C2. it is this probability A2 mean, B2 standard deviation. Normal distribution E7, E17 is okay. Okay, with this return, right? With this return value, right? With this return and the mean and standard deviation. Okay, if this return were to happen, right? If this return were to happen, right? That would be, you know, bottom 0.2% probability, right? So the bottom line is overall, the conclusion is overall, our distribution is not normal. It's not exactly normal. Why? The blue is the normal, likewise normal distribution. In other words, normal distribution would show this type of cumulative probability, right? Scenario, so we can tell the scenario, our scenario is skewed to the left compared to the likewise normal distribution. So in other words, it gives us an extremely extremely exaggerated negatively skewed outcome, right? So the horizontal axis is the continuously compounded rates, and for us to have this low return, negative 46% return, that kind of, you know, return, which our scenario gives us, in normal distribution, it would have like not even 10% probability. These are it would be like 0. It's barely, you know, crawling at the bottom, right? 0.2% probability. And this type of return has, you know, a cumulative probability of on the normal distribution, cumulative probability of something like 11 point, what was it, 11 point something? 14.9% or 15%, right? But our scenario was giving us like 30% cumulative probability, and on the normal distribution, this type of, you know, this return, right, would have, you know, up to this return, the cumulative probability would be 60%, but our scenario analysis is telling us, you know, there's a 70% probability of this. And total would always be, you know, add up to 1, but, you know, that type of, you know, the cumulative, the cumulative probability of, you know, all the way up to that return is actually, you know, on the normal distribution, 80 something percent. So this tells us our scenario is skewed to the left, you in other words, what we see is more like this, right? Our distribution is more like this. Our scenario is more like this. So, okay, that's how we verify. That's how we verify if our scenario is normally distributed or not. And then that would serve us to, and I don't know why they brought, value at risk here. I mean, it doesn't, of all the parts, all the sections, all the chapters, if they were to bring in value at risk, of course, this is the best place. But then, value at risk is not really pedagogically, it gives you something, but it doesn't really have that much, practicality. But since they talk about this, I'm gonna briefly talk about this in the, or may skip that, but here's something I just want to show you. I mean, skewness and kurtosis. Kurtosis is how fat or how tall, right? Skewness is, literally skew, left skewed, right skewed, negatively skewed. Our distribution was more like this. Our scenario was more like this. And then kurtosis is, how tall the distribution is, or so this is something you can just read up. So I think we'll have to talk about this. I mean, we cannot spend too much time on the um, as much as I want, because we're out of time and we got something to cover. It's 11:40 already. So we'll take a 10-minute break and come back at 11:50. Okay, let's take a 10-minute break. Come back at 11.
Hello, Professor? You still there?
We're on break, bro.
We're on break.
All right, we're back. We're back. This is really race against time, and or what should I say, race with time. I mean, I cannot outrun the time, um, and there's absolutely too little time for too much, that we have to do. Um, That's why there's main lecture, and I want you to whatever I can't cover during the collaborate, you should supplement it by watching the main lecture. Okay, and so some examples I may not, especially something of value at risk. Please watch the main lecture. Um, so. Our next question is then, oh yeah, we know how to calculate return and how to calculate risk, which is standard deviation, variance and standard deviation, right? So how do we use it to our advantage? I mean, how do we, so first, this is a simple idea. I mean, this idea has been, championed, since, or advocated since Finance 100, return risk ratio, or gas mileage. Now think about it. You should remember what gas return risk ratio or mean variance ratio is, and I used gas mileage as an example because for almost everything, right? Measuring the efficiency. How do you measure efficiency? Efficiency is basically efficiency, or actually it's productivity, but higher productivity is efficiency actually, right? Productivity. Uh, how do you measure that? It's output to input ratio, isn't that right? Output to input, right? And I've been telling you from Finance 100, a typical example of this is gas mileage. Because what is gas mileage? Gas mileage is exactly, how many miles, right? Over how many gallons, the input, right? So if you divide miles driven by the gallons used, that gives you the fuel efficiency or fuel economy. But that is the productivity of the engine. That's the productivity of the car, isn't it right? Now, the higher the gas mileage, that means the more productive or the more efficient the car is, right? The same idea. If when we measure, the efficiency or profitability of the investment, it's basically, what's the output? Return. And what's the input? Input is the risk, right? You can say, benefit cost ratio, right? But in terms of it's also called reward to volatility ratio. I mean, let's say you bought Tesla, and if you paid $900 for Tesla, and if Tesla goes up, of course you will have positive return. You'll have but if it falls below 900, you have negative return, but that's not really why you are investing. I mean, when you're investing, you have to consider because the price can change either up or down, right? And that's called volatility. I mean, that's basically that's the variance. The volatility is the variance. So the variance is the risk, and risk is what we run. I mean, risk is what we have to take to get certain return. Risk is a range. It's not a point value. It's a range, right? So then it's obvious. Yeah. Then what is the risk? We know that the risk is a variance. Okay. Variance of it can be variance of individual stock or variance of a portfolio. Okay, we'll consider portfolio, and then what we need to measure, if it is a portfolio, right? What we need to measure is the excess return or risk premium. Now, if it is an individual stock, you can use return risk ratio for individual stock. But for portfolio, we'll have to use excess return or risk premium. But actually, there is a difference between excess return and risk premium. Because risk premium is the expected return in excess of the risk-free rate, whereas excess return is the required return or rate. I think this is ROR is usually rate of return, but I think I used it to mean required return. You understand the difference between required return and expected return. Expected return is, okay, I'll write it here. Expected return can be greater than or less than or equal to the required return. Okay. And expected return will be equal to required return in equilibrium. And the expected return, so what is expected? Expected return is the average of the past returns, right? Expected return is the average of the past returns. A required return is determined by CAPM, capital asset pricing model. So I believe we talked about this at the beginning of the semester. If the expected return is greater than required return, then the stock is undervalued, right? stock is undervalued. And vice versa. If it is like this, then stock is overvalued. For the expected return to be, for this to happen, then the price has to be lower, right? For this to happen. For the other scenario to happen, the price of the stock should be, higher. Then then what? Then the rational price or intrinsic value rational price or fair value is what is predicted by required return. And the required return, so that's, what is price of the stock at time 0? It is, dividend at time 1, right, over R minus G, golden growth model, right, remember? And what is this R? This is the required return, isn't it right? That's the required return. And how do you find required return? CAPM, right? So think about it. If the expected return, which is the average of the past returns, if this is higher than what the Gordon model is predicting, if the expected return is greater than the required return, that means this number is small, right? This number R is small. You can't say that. You cannot say, R is small. Whatever R may be, the only way the expected return to be greater than required return is so I'm gonna have to the market price. So usually I use the market. This is the market price. But so I should have changed this. Let's call it intrinsic value is S0, right? Only if market price is less than this price, intrinsic value, right? Intrinsic value is basically equilibrium, the price that would be expected at equilibrium, right? So if the market price is lower than, in other words, undervalued, then the expected return will be, you get, higher expected return than required return. But, aside from all that, so again, as I said, expected return will be equal to required return in equilibrium, but otherwise the difference between the two would be the residual or the error. Error term, right? So the bottom line is whatever you earn over and above the risk-free return is excess return, right? Excess return. And that's called, and the risk-free, we know what risk-free return is. It's very short-term safe, very short-term safe, return from the investment in the safe instrument, such as 3-month to 1-year T-bill, right? Or it's not only that, and I said this before. Not only that, but also short-term risk-free assets. Could be treasury, tips, money market instruments. Money market, short-term. Money market means short-term, right? Financial market. So money market instruments. I don't know why the color is a little weird. And then CDs and commercial paper. Commercial paper is what? It's the money market instruments. Commercial paper is a short-term corporate bond, right? These are all, risk-free. But, the king of all the risk-free assets is, of course, treasury. And so think about it. If your excess return is 10%, but the risk-free return is 5%, nobody can do below 5%. I mean, unless you are extremely unlucky, so you invested in stock that is, that is failing. I mean, if you are a completely risk-averse person, what would you do? If you don't want to take any risk, you wouldn't buy any stocks. You wouldn't put your money in the stock. Instead, if the treasury pays you, or even the bank CD pays you 5%, you will put your money into the treasury or CD, the risk-free. So theoretically, nobody can do worse than the treasury, the risk-free return. Right? Makes sense. Nobody can do. So that's why, the true risk premium, true in return risk ratio, the true return is the risk premium, or the risk premium, right? So risk aversion is, we all understand what risk aversion means. It's the people are, there are risk takers and risk averse people, or risk averse people, risk averse. And we are all on the spectrum of that risk aversion. I somehow, I like, safety, but, you cannot, what is the safety these days? Federal Reserve raised the FOMC meeting, last FOMC meeting, they raised the Fed funds rate just by 0.25%, and they are saying, in May meeting they're going to raise it by 50 basis points. But still, if they raise it to so then what? Fed funds rate will be 0.75%. But with 7.05% Fed funds rate, the CD rate won't be much higher than, what's the CD rate these days? Probably, 0.5, 0.75 at best. But if you when, in May, if they raise the short-term rate to 0.75. Still, CD rate will be at best 1%. So this is the reality of what is safe, right? If you buy, let's say, 10-year Treasury note, yeah, probably currently you will get, and 10-year Treasury note is the benchmark for long-term interest rates. And if you put your money into 10-year Treasury, I think 10-year Treasury is paying about somewhere between 1.75 and 2, somewhere around that. Even if it is 2.5, what's the inflation? Inflation is like 8.6, 8.5, 8.6. You get negative real return. So that's why people need something like, that's why people invest in stocks, although stocks are risky. And that's why people invest in tips, right? Because it's protecting against inflation. But, so we are on the spectrum, somewhere, our risk aversion is, I like safety, but I also invest a lot in NASDAQ, ETF, right? A lot of ETFs in NASDAQ. And I lost from the high, like almost 11% as of yesterday, 11% from its highest point. And the highest point was like January 3rd, something like January 3rd, January 5th this year. And since then, it's been all, down market, So from the highest point, I lost about, 11%. But that's the risk I have to take. Isn't it right? That's the risk I have to take. If I cannot just, indulge in safety of the low returns of CDs and Treasury, right? So risk aversion is measured by price of risk. Name, A stands for, what do you think A stands for? A stands for aversion. So it's a metric. It's a measure of risk aversion, and because the true risk premium is the difference between expected return and the risk-free rate. So risk aversion is the ratio of, or price of risk is the ratio of risk premium to variance. Yes, variance. And then, of course, variance would be a very small number compared to standard deviation. Remember, if the standard deviation is like 20%, 0.2, variance would be only 4%, right? 0.2 times 0.2, 0.04, right? So the conventionally, risk aversion is somewhere between 1.5 and 4 conventionally. And the market price of risk, so in other words, market risk aversion measure using S&P 500, and assuming all short-term borrowing is equal to lending. So in other words, there is no leakage. All the this assumption will hold that this assumption will support the idea that if it is not in stock, it would be in. If it is not in stock, it would be in risk-free assets, so market risk, price of risk is average investor, assuming that okay. So is what the average investor holds, right? If average investor holds complete portfolio, what is a complete portfolio? It needs to be explained. Complete portfolio is the risky portfolio plus risk-free assets, right? It's completely portfolio. A risky portfolio would consist of stock portfolio and bond portfolio, right? Later you will see. So market risk, market price of risk is average risk aversion, right? So using S&P 500 as so. Look, the bar on top, right? If you put bar here, right, on top, that means average. So then this is what market risk premium, right? Market risk premium over sample variation of the market. Sample means, it's not population data. It's just local data set. Because we inevitably we cannot use last 120 years of S&P 500. I mean, we can only use some subset of the population. So average market risk aversion conventionally 2. So in other words, you want if your risk aversion is 4, that means you want 4 times higher risk premium than the variance of your portfolio. And average market risk aversion is 2. That means, we understand what that means. But again, that is when you use variance. Variance is a small number, actually. So if we do it sharp ratio is more. Sharp ratio is what should I say? More painful number. More painful. The same thing. It's just like risk premium over standard deviation of the portfolio, right? So if this is not variance but portfolio standard deviation, then obviously this number will be much lower than price of risk, right? Again, Sharpe ratio or the price of risk are good for valid statistic. That means metric only for portfolios, ranking portfolios, not useful for individual securities. Okay, individual securities is return risk ratio. Similar thing. There's a similar measure of return risk. Trainer ratio. It's the same thing. Only the difference is beta instead of standard deviation. So that's I really I think we'll have to talk. There is some empirical studies. I want you to read that. So we're gonna go to asset allocation, but we are out of time. So we're gonna have to talk about this in the next class. Okay, it will be more interesting discussion. But next class we really have to go into efficient diversification, and then too much to do, but too little time. All right, so that's it for today. Any questions so far? Any questions? Okay,
Professor.
please.
Sorry, I was late. Can you put me for late attendance? Is that a thing?
Yeah. I mean, look. Don't tell me I can't I won't be able to remember that later, but you put it here.
I did. I did.
Yeah. Then according to this,
Okay.
I will know, right?
Professor, I do have also a question. I
All right.
did attend
You did
April.
what?
I attend on the session of April 9th, but
Uh-huh.
I don't know why it didn't record my my discussion, like my and then I just saw
April
that
9th.
on, yeah,
Okay, who is this?
Sebastian.
Sebastian. Okay, let me
Yeah.
check. April 9th. April 9th. April 20th. April 9th.
I just realized that because I was seeing your the Excel
All
that you
right. Bye-bye,
posted with
Professor.
the data
Hold
analysis
on.
of the midterm 1 and midterm 2 in attendance, and then I don't have
Mhm.
for April 9, I have a 0, but I have attend all your sessions.
Okay, April 9th.
Yeah,
What's your name?
Sebastian Giraldo.
Sebastian. Okay. It's an alpha. I don't see your name here.
Yeah, that's what I think. I don't know why, but it didn't record. But I
Mhm.
did attend your session
But there's a way I can verify that. Look, so Alpha, you have a question too,
on the
Alpha?
recording. Yeah,
Sir, when is the final?
this weekend.
Uh, no. Listen,
I know
I
this
will
is
answer
mid.
that question later, okay? Because that final is still, we don't, you have to focus on exam midterm 3 now. Final, of course, after our last day, right?
Yeah.
Wait a minute, okay. So I will get to that later. But what am I trying to do?
Okay, so we got to do the midterm 3 after that is finals.
Right. Okay, so who was Sebastian, right? Sebastian. So let's do this. If I April 9th, if you were here, it will be in the. Let's see. It's not in alphabetical order, so it's a pain to go. Sebastian. But here I don't see you here, Sebastian. I mean, if you logged in the whole time, look at this time there. It was everyone was logged in for like 2 hour 50 minutes, 2 hour 30 minutes, 1 hour. Oh, this is almost 2 hours, 2 hour 49 minutes. I mean, that would be normal, 2 hour 45 minutes because if it is around. But then if you were logged in, it would be here, but I don't see your name there,
Yeah,
right,
yeah, I should
Sebastian?
have been there, but
I
I'm
don't know. I
yeah,
mean,
yes,
whether
sir. Yes, I am seeing that. And I'm also checking the live recording because yeah.
yeah, in the live recording, your name may appear there, but look, uh, regardless of whether you do the attendance reporting in the discussion board, regardless of that, that's what you do. But this automatically records because this is collaborate session that automatically records who is logged in, right? Whoever is logged in is recorded here. So that's why I couldn't,
Okay.
I had to mark you
Yeah, no,
because your
don't worry. I
attendance
think
couldn't
I
be
don't know. Maybe I'm
validated.
confused, but I
Huh?
think yeah. Maybe I'm confused, but I'm pretty much sure that I have attended all of your sessions. May I have my
Well,
like
yeah, if you did, I would appreciate it. But then go back to
yeah,
April 9th recording,
yeah,
and as you play that, if you see your name in the
in the
you
recording,
know
yeah, I
yeah,
will
in the
let you know.
recording like that, take a picture of that,
Okay,
screen grab, right? Your name
and I'll
will
send you an
appear
email.
like
Perfect.
this, yeah, and then attach that screen grab to the email and
Okay.
send it to me. Okay.
Thank you, Professor.
Alrighty. Alright, you're welcome.
Just another one. The midterm 3 is also with what we saw today, right?
Yeah, it includes, what you have, what we
Standard
covered today.
deviation, C-score, and all
Yeah,
that.
yeah.
Okay. Thank you.
All right, you're welcome. So I'll have to stop recording